Look at SE6. SE6 says Vivaldi Company has assets of $280,000 and liabilities of $120,000 at the beginning of the year. So if the assets are $280,000 and the liabilities are $120,000, what does that make our owner's equity? $160,000. The asset at the beginning of the year, and assets at the end of the year were $400,000 and liabilities of $140,000 at the end of the year. So what would that make our owner's equity at the end of the year? $260,000? Okay, so we have the beginning owner's equity plus we have the ending owner's equity, don't we? But it now says to us, we've got some more information. The owner invested an additional $40,000 in the business, and the company made withdrawals of $48,000. What amount of net income did the company earn during the year? So do you see if we set it up, we know the beginning of the year, owner's equity was at $160,000, don't we? We know at the end of the year, owner's equity was at $260,000, don't we? We know the investment of $40,000, we're going to add. The withdrawal of $48,000, what are we going to do there? Subtract. So we can figure out what the net income is by our $160,000 plus $40,000 minus $48,000 plus or minus something has to equal $260,000. See what we're doing? See how it calculates it for you down here? So we know our net income needs to be $108,000 because what we started the period with plus our investments minus the withdrawals plus the net income equal our $260,000. Make sense, guys? Okay, let's go back here to the PowerPoint. Next thing we're going to do is talk about these financial statements. This is really important. I want you to know what each one is about. You'll see this again. So what we're going to do is talk about these financial statements that we use to present this information to end users. The income statement is pretty good. The income statement shows the net income, okay? Then we're going to talk about the statement of owner's equity, the balance sheet, and something called the statement of cash flows. I'm going to tell you right now, we're not going to spend much time on the statement of cash flows in this class. You'll have plenty of it for next time. So as you see here, the income statement, our revenues minus our expenses equal net income. The statement of owner's equity, kind of guys, we've been doing that anyway, just in these past couple exercises. We're showing what we start the period of capital with, what we add to it, and our ending balance of capital, owner's capital. We're going to talk about the balance sheet and the statement of cash flows, not really. So as you see here, they all flow together. Do you see how you need the income statement? You need to know what your net income is before you can figure out your statement of owner's equity, because you need that net income to add to your owner's equity. Do you see in order to do your balance sheet, you need your owner's capital at the end of the period? And then the statement of cash flows ultimately benefits you in knowing the cash from different activities, but we're not going to go there. So the income statement. This summarizes the revenues earned and the expenses incurred by a business over an accounting period. The important concept here is we measure income over a period of time. We don't measure income since the inception of a company. We measure it usually over a calendar period, right? Over 12 months or over a month. So the income statement shows the revenues earned and the expenses incurred over a period of time. Many people consider it the most important report. It's debatable if it's that or the balance sheet, because ultimately the balance sheet brings it all together. So basically, the income statement is for a period of time. So it shows when it began and when it ended. Here's a good example of an income statement. Roland Consultancy income statement for the month ended December 31st, 2014. The title is really important because you need to know what this statement is about. The first thing we always show are the revenues, and then we show all the expenses, and the difference is, voila, net income or net loss, okay? We're going to go through some of these problems, so we'll work on income statements together. The next one is the statement of owner's equity, which we kind of were doing in some of those problems. It shows the changes in owner's equity over an accounting period. And we're doing them, guys. It's going to be the beginning balance. We're going to add investments. We're going to take out any withdrawals and then add net income or subtract net loss. We've been doing that, right? Now, we need that net income from the net income statement or the financial statement to flow into the statement of owner's equity, don't we? Don't we? So if you get a question, hint, 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 which is the first financial statement you must complete? What is it? Do you get it? You will see that again. Get it? You have to have the net income in order to do the owner's equity, in order to do the balance sheet, don't you? Make sense? Okay. So here's an example of the owner's equity. Do you see how it starts with the beginning balance in the equity? Owner's equity, T. Roland Capital, December of 2014. Then, see, he started with nothing. He just started the business. It shows his investment. It shows his net income. Then it subtracts his withdrawals to come out with his ending capital balance. Do you see how easy that is, guys? Truly? The purpose of the balance sheet shows the financial position of a business on a certain date, usually at the end of a month or a year. Guys, the best way to remember a balance sheet is a snapshot. Do you know, like, when you take a picture with your phone, it just captures right then? Think of a balance sheet as just a snapshot in a point of time. It's not like an income statement that shows over a period of time. It just shows a snapshot. Think of this. I would love to do a balance sheet before I've paid all my bills, because I'm showing all my cash. You know what I'm trying to get? But will my checking account change overnight very drastically? Yes. You see, it's just a snapshot. Get what I'm saying? At a point in time. The minute you have another financial transaction, what changes? The whole thing. Doesn't it? So the balance sheet is a snapshot in time of one particular moment. The income statement is over a period of time. Know that difference, guys. Also know that another name for the balance sheet is the financial position of a business. Okay? Some people will say it's the income statement. No, it's the balance sheet. Okay?
You said it was another name for
the statement of financial position. You will see, that might be a question for you. No, the statement of financial position is also known as a balance sheet. Okie doke? Yep. The date on the balance sheet is a single date whereas the dates on the other statements cover a period of time. Okay? Owner's equity, income statement cover from the beginning of a period to the end of the period. Balance sheet's just one point in time. Snapshot. So you see here the balance sheet for Roland Consultancy. Do you see how we had to complete that statement of owner's equity to get the ending balance so we could flow it into our balance sheet here? So we needed to complete the owner's equity before we could do the income statement or the balance sheet. And in order to do the statement of owner's equity, we had to do the net income statement or the income statement. We're not worrying about cash flows. Now, guys, our cash flow is important, absolutely. But I just don't want to focus on that right now. There's enough to learn. Okay. So here you see something we're going to apply. Complete the following financial statements by determining the amounts that correspond to the letters. Assume no new investments by owners. So, what's the first thing we need to do? We need to know our income statement, okay? But we might have to go to our statement of owner's equity to figure it out, won't we? So if our beginning balance of our statement of owner's equity is $7,250, we're going to add our income, we're going to subtract our withdrawals to come up with an ending balance of $7,500. What was our net income, guys? $750? Perfect. Do you understand how we got $750? The $7,250 plus $750 gives us $8,000 minus our withdrawals of $500 give us an ending balance of $7,500. Make sense? So we can take that net income of $750, make it be B here, right? So our revenues of $2,775 minus what gives us $750? $2,025. Great. So we know this is really important because it helps you see the relationship among all these accounts. If we know our liabilities are $4,000 and we know our owner's equity is $7,500, what are our total liabilities and owner's equity going to be? $11,500. What will our assets be? Do you guys get that? $11,500. So what I want to do is let's go and look at a couple more of these. I find the best way to learn is just doing them. How are you guys doing so far? Peachy? Okay. Let's look at exercise 11A. Okay, 11A, guys. I'm going to do it the same way here. Do you see we have two variables for our income statement? How the heck are we going to figure that out? Well, we know that our statement of owner's equity has everything we need except the net income, right? So if we know our beginning balance in our statement of owner's equity is $29, we withdrew $2,000, that brings it down to $27, and the ending balance is $30. What does that mean our net income has to be? $3. So we can take our net income of $3, bring it up here to our income statement. So if we know our revenues are $11,100, What are our expenses going to be if we know our net income is 3? 81? Perfect. Then, if we know our owner's equity is 30,000, our total liabilities and owner's equity would be 46, and our total assets would be, make sense? So let's go back and look at the solutions. How do I download this sucker? Where are you? Where was I? 12? 11A? Okay. $11. So you guys, here's the solution. Again, you can set it up, but if you know what the net income is, then you can figure out your expenses. And then if you know what your ending owner's equity needs to be, assets equal liabilities plus owner's equity, you can calculate all those figures, can't you? Right? Okay. Now what I want to do is go back here another time and talk about something called generally accepted accounting principles. Every industry has rules or guidelines they need to adhere to. In accounting, we have guidelines called generally accepted accounting principles, which tell us and teach us how we are to process and communicate those transactions appropriately. We call it GAAP, Generally Accepted Accounting Principles. These principles have been established for years, and they are revised and updated over periods of time. They basically give us guidelines as to how we're supposed to transact and communicate this information to users. So basically, the main thing to know is we have guidelines called Generally Accepted Accounting Principles. I'm not going to go into, know that FASB is a big organization that helps us to create those generally accepted accounting principles. That's really all I want to talk about. I don't want to get into all this right now. We got enough to do. So the main thing is know about generally accepted accounting principles. You don't need to know about the standards. You don't need to know about the various organizations. Okay? We'll touch on that. You'll touch on it plenty of times. Now, what I want to talk about is ultimately, why are companies in business? Hello? To make money, for the most part. Now, Keith's dealing with something where it's a nonprofit and there's a different motivation or purpose for that. But generally speaking, most businesses are around to make money for their owners or for their shareholders, right? Profitability, the ability to earn enough income to attract and hold investment capital. How many of you guys are going to invest in a company that just keeps losing? Hello? If I'm going to spend money, I want to spend it in a fun way, right? We don't want to keep losing. Liquidity is another term we want to be familiar with. You can be profitable, but if you're not getting your money in from customers and you can't pay your bills, are you going to stay in business? So you not only need to be, what?
Circuit City.
No. You need to not only be profitable, but you need to have liquidity. You need to get your money in order so you can pay your bills. And then ethics, we'll talk about down the road. So basically, liquidity, profitability are two items that are required in order to have successful businesses. I want you to look at this slide. We were talking about outside users, and we were talking about people who need information for companies. Think about these. Management, they're all internal users, right? Those are internal users within the company. External users are more those related to investors, creditors, taxing authorities, governments, customers. Those are external users. Know the difference between the two. They're going to want different types of information. Management's responsible for running the company, not the shareholders, management. They need to make good decisions. Investors are people who are going to use their resources to invest in the company. They definitely have a true reason why they need information, and that's basically a financial interest to potentially have it as an investment. Creditors are similar to investors, but since they are lending the company money, they definitely have a financial interest to make sure that the business is going to be viable and a going concern down the road, don't they? So know the difference between investors and creditors and why they have an interest. And again, taxing authorities can tell you we want to see everything. So they want to make sure you're paying enough taxes, you're paying your payroll appropriately, and if you're subject to certain regulations, that you are adhering to OSHA laws and requirements or whatever those entities are that you're responsible for. So know the various individuals. I'm not going to cover that. Businesses, basically, their goal is to sell either goods or services that basically provide a profit and give them money back to the owners or shareholders. Two major goals of all businesses: profitability and liquidity. Are you guys going to forget that? Do you hear me saying, like, do you get how blatant I am? You're going to remember this, right? Will you see the words profitability and liquidity again?
Never.
So basically, there's three ways companies try to achieve their objectives. Operating activities are those activities a company performs for the reason they're in business. So, for example, if it's Keith's business, operating activities would be going and procuring the sheet metal and turning around and finding ways of selling it. That's the reason he's in business. I'm in business to provide a service for tax returns. So anything I do in relationship to providing that service is part of my operating activities. Investing activities are basically resources that are purchased and sold that they may or may not be related to the operating activities, but it's ways in which a company may invest. And then lastly, know the way in which you finance those activities are under a separate activity called financing activities. So I just want you to be aware there are business goals such as profitability and liquidity, and we've got three different types of activities businesses perform: financing, operating, and investing. So, right now, I'm not going to worry about that. I'm not going to worry about that. What I'd like to do is I want to go back. How are we doing? We've got 20 more minutes. Y'all want to take a quick break and then we'll start on homework problems? How you doing? Just do homework problems?